I think this is another very interesting question. So ETFs, I think, are now a crucial element of investor exposure. They're no longer just a small part of the portfolio structure. And I think they're really deemed as a core focus and a very important building block in portfolio construction. Passive investment it accounts for about half of all managed assets in the total investment market. So these funds are, in terms of ETFs, really, I think, give a new optionality for investors in terms of the way that they integrate ESG into their overall portfolio and asset allocation mix. And the very interesting thing about ETFs, of course, from an Asian perspective, is that they open up the opportunity for ESG investing to a broader segment of investors. And we know how important the retail market can be for some of the core markets in Asia. So from that perspective, it's a very interesting sort of democratization here of the access to ESG investment strategies. And that's not in any sense to underplay the importance of ETFs for institutional investors in terms of the liquidity that ETFs can provide, but also I think the range of strategies and the range of different approaches to integrating ESG within that are available within passive assets, and in particular within ETFs. And I think they're the focus on choice. There isn't a one-size-fits-all approach to integrating ESG, and you'll find some investors that really want to, retain an exposure that's very close to benchmark, but they still want to have the ESG exposure, maybe as a tilt, for example. And you'll find other investors that want to really base their investments around the outcomes, the sustainability uplifts that you can get from a very sort of strong approach to baking ESG into an index fund. And here is where I think you get a very interesting option from using passive strategies within an ESG integration approach. Because I think the one thing that you can be sure of with an index when you're looking at ESG and how you build that in is really the fact that you have a very rules-based way of integrating ESG. So it's going to be consistent across the whole portfolio rather than applied to a portion of the assets in that portfolio. So in many senses, the fact that index funds have to be deeply regulated and very transparent with the market around how they're constructed, what the data inputs are, for example, means that investors have that much more, insight into the strategy around how ESG has actually been considered and baked into the portfolio from sort of the ground up, from the construction through to the end output, and understanding how does that relate to a benchmark. So, what is the carbon reductive element that you get from using climate scores, for example, in an ETF strategy. So in that sense, I think we're really seeing a growing focus on ETFs as not only as part of the portfolio, but also as a solution for integrating ESG, because you get that much more, I think, range and accessibility with ETFs.